Everyone is trying to time the market, but very few people think about actually how different cycles and how different markets are structured. When we think about the very long term, when we think about the stock market, we've got cycles of many years, right? We've got recessions of 2-3 years, and we might have to hold an asset for 20-30 years just to break even after inflation. When we look at the Bitcoin cycles, we also have multi-year cycles. We tend to move in 4-year cycles, at least historically. If this will continue in the future, nobody knows. But the attention tends to be moving in 4-year cycles. In other words, when there's a bear market, not a lot of people look at crypto. When we are in the bull market, everybody gets hyped about crypto. But the smaller we get with the market, the smaller we get with the potential asset or the potential capital that's getting invested in an asset, the shorter the time frames tend to become. So we've already shortened from the long duration stock market to the shorter duration crypto market. But when we now dive a bit deeper, when we look at, for example, the different blockchains, then we see that attention might be moving for one day, say the Ethereum chain, to maybe then the next few weeks and months to the Solana chain. And then subsequently it might be moving to the next chain, right? Right now it seems to be moving to the base chain. So there seems to also be an attention shift and also a price shift between different chains. And that tends to be faster than just the Bitcoin cycle, but it still tends to be slower than, for example, for individual assets. Right? When you just look at a meme coin might be going up for just a few days and then completely deflate, and then the attention moves to the next meme coin. So in other words, the smaller the market is, the faster you have to adapt to the changes. When you're trading in small meme coins, you have to look out potentially several times per day what the next big thing could be. You always have to be ready with your finger on the trigger to sell a certain asset and to buy a new one. When you're just swapping and just betting on a specific chain, then you might have a bit more time, but still, right, there are trends. And at some point in time, Solana might not be the big thing anymore. It might be base. It might be something else afterwards again. So there is a shift happening also for the chains themselves, but it's simply slower. And then when you go just for the general market as crypto, you've got all time in the world, right? You can simply just check the prices, check the relevant indicators every few weeks, maybe every few months, and then just buy, say, when the Bitcoin is below the realized price. That's a very simple way to time bottoms. You look at the realized price, you buy whenever it's below, you get in heavily, and then you sell whenever, say, the MVRV score is very high, right? The market value to realized value Z-score. So it's very different how to generate alpha in those different parts of the market or across those different asset classes, right? And it's also very different as in how much time you need to invest in order to beat the market. If you're just allocating to stocks, then you pretty much don't have to put in any time whatsoever, right? You just dollar cost averaging in your 401k by putting aside parts of your salary in that ETF product, right? In say the QQQ, that's for the NASDAQ. You just put in some money in a low-cost ETF and you just ride out the waves. So that's like completely hands-off. For crypto, even if you just buy Bitcoin, it's already a bit more hands-on because the volatility is so much higher. Most people don't want to see even parts of their portfolio, individual positions, to drop by 60-70% from the all-time high. So there, just completely waiting it out might not be that sensible. Still, you have to look at it sometimes and you have to get in massive once we are low, below the realized price, and you have to also sell massively once we are above, because simply the volatility is so high, right? From the bottom, say, to the next cycle peak, it can be a 10x. But if you're simply just riding out those waves, then as a allocation, as a percentage allocation of your overall portfolio, crypto expands massively temporarily, might take up 30, 40, 50% of your wealth, and then contracts massively again and only be 5% of your portfolio. Do you really want that, right? Even if you don't want to necessarily time the market that much, do you want to have that different of a risk profile for your overall wealth, depending on where we currently are in the crypto cycle? Probably not. So you have to adjust, right? You have to buy in more when we are low, when you're relatively underexposed because the prices all collapse, and you have to take profit as we go up, simply just to have a balanced portfolio. And when it comes then to individual blockchains, I believe we are already getting into very much active trading. The difference between just riding the cycle, say in Bitcoin, or riding the cycle, say in the stock market, is that we can be relatively certain that both of those two things will still be around in 10, 20, 30 years. So even though it's not optimal, you could simply just set and forget it. For individual altcoins and also for blockchains, that's not necessarily the case. If you're just dollar cost averaging into a few assets on a certain blockchain, you might still never recover at some point. For example, Phantom, right? Phantom was the big hyped blockchain 4, 5, 6 years ago, probably rather 4 years ago. And then came a huge hack of one of the main bridges, the multi-chain hack. A lot of the assets that were traded on Phantom came through the multi-chain bridge. And then once that got hacked, even the stable coins depacked. The chain pretty much became useless overnight. You couldn't pull out your funds anymore. So you bridged over funds, you made some money on the Phantom chain, you couldn't take out the profits or even your initial from that chain, and you are gone, right? Imagine you just want to ride out the waves, you simply just want to wait for the recovery. It might happen at some point, but then, all the different assets on the Phantom chain would also have to get backed one by one again by a legitimate bridge. So things aren't that easy once you go too micro on different chains. And it's even more important once you go into different assets, right? Blockchains don't die that quickly. Blockchains very often recover. Not always, like in Phantom, but most of them will still do some kind of activity in the future, even in 10 years. For individual assets, that's completely different. So I recommend you to go to coinmarketcap.com/historical. You can simply just search for CoinMarketCap historical. What you will see is the top crypto coins, the top crypto tokens based on the dates. So you can basically travel back in time. So you can look at what were the top 100 cryptocurrencies and what price did those cryptocurrencies have, say, on the 1st of January 2019. You can just have a look. How did those top 100 coins look compared to the top 100 today? How many names do you still recognize? What's the current price compared to the price at that point in time? And what you will notice is that the vast majority, I don't have a number, right? But just by feeling, it's probably 70 to 80% of tokens, they will not be around anymore. They will not be known anymore. They will not be in the top 100 anymore. And I'd go that far to say that probably 90%, maybe even more of the tokens 5 years ago did not outperform Bitcoin in those 5 years. In other words, a lot of them are completely forgotten. The ones that are not forgotten, they at least did not outperform Bitcoin. So that's very interesting, right? It's interesting that you take on so much more risk, but in the end don't get compensated for that risk in aggregate. And that's obviously also true. That's true to early investors cashing out. It's also true to increased competition. There are more altcoins over time. That's due to token inflation. Maybe you stake your coins, you get a few extra coins. There's all kinds of effects that potentially worsen long-term performance of altcoins. And there's simply just too much conflict of interest. So it does not necessarily make sense to just hold those tokens for long. It makes more sense to trade them actively. But again, the smaller you get with the asset, the more important it is to time this right, and the shorter those attention waves come, right? For meme coins, that's very, very fast, right? You have to potentially just hold this for 1 or 2 days. For, let's say, larger DeFi protocols, let's say Jupiter, let's say Aerodrome, this is a bit longer because there you don't bet on a single meme coin. You're just betting on the overall meme coin trading to continue. Then for a basket of coins on a specific chain, it's even longer, right? Because the chain might be around for a bit longer. And then, of course, for crypto, it's even longer. So there is a direct correlation between time invested, size of the asset, expected return for the amount of learning you put in. You don't have to learn that much to ride the Bitcoin waves, but you do have to learn a lot in order to ride the meme coin waves properly. And then, of course, if you go more serious with the asset, it does tend to have a longer lifetime. But again, it's just a longer lifetime. It still means that you have to, from time to time, shift to other assets. If you're just buying and holding, then just sticking with Bitcoin makes most sense. And simply just rebalance your portfolio, right? That overall your risk allocation doesn't get out of whack, that you don't have half of your wealth in Bitcoin when Bitcoin is very close to its all-time high, right? That's a bad idea. You want to have rather very little of your portfolio when Bitcoin is already that high, and you want to have a lot of your portfolio in Bitcoin when Bitcoin crashed already 50, 60%. We want to do the exact opposite, and there are these effects that make this whole wave stronger and stronger, right? If currently the price goes down, then obviously your allocation in the portfolio goes down with it, simply with the price. But at the same time, because it went down, you want to have more allocation. So let's say you would have a target allocation of, say, 10% to crypto. And now Bitcoin gets cut in half. Suddenly your allocation to Bitcoin is only 5%. But you don't just want to top this up back to 10% and buy more Bitcoin. You want to top this up maybe even to 15 or 20%, because now Bitcoin is so much lower after it crashed. Right? So there is some kind of an effect. There's a two-sided effect. There's the effect that you have to buy more when it crashes because the allocation is lower, but you also have to buy more because now the market is cooler. And the same is true when it rises. Right? When it rises, you're over-allocated relative to your 10% because Bitcoin doubled or tripled. But at the same time, you also don't want to necessarily have even 10% of your wealth anymore in Bitcoin because we're now that high and so heated. And so maybe you only want to have 5% at the time in Bitcoin. So things to think about, right? Timing the market is very different for different parts of the market. It needs more effort the smaller you go. You obviously also have more alpha the smaller you go. But yeah, it needs more skill. It needs more analytics. And if you're simply just riding the Bitcoin wave, things can be easy. If you want to make this a real active income almost, then you have to do active trading, and don't make the mistake to think about all those markets in the same way, right? Don't start actively trading the NASDAQ. Don't start buying and holding a small meme coin over several years. Don't mix this up. Try to adjust the strategy based on the nature of the market. At least that's how I personally do it. If you found this useful, feel free to give this a like. I publish videos regularly. It will also help the channel grow. Feel free to subscribe as well. See you next time. Cheers.